to get it rolling with the city, but now it's going really, really smooth. And so he has these ADUs going in. He has some of them already rented, some of them he's still putting onto the property. But you have a piece of property that I haven't even talked about the value of the house that's actually on there, right? It was all of a sudden he's turning on a spigot. What is that? About $25,000 a month in extra unit. And if anybody had looked at it, they would have said, "Oh, that's a horrible property." So sometimes you have to do a little bit of a what if, what can I do? So let me show you how this stuff works. Generally speaking, we look at personal and business on one side, and I'll just put I'm going to put this in a different color so you kind of see it. I would say that this is the active side. And this is the passive side. So we would take somebody, we would look at their estate, and we break down their personal assets from their business assets, their risk assets from their non-risk assets. And if I was doing this from an asset protection standpoint and a tax planning standpoint, we would spend a lot of time breaking it down. But I'm going to give you the 10,000-foot view. Your personal assets is you. Oops. Sorry. Let me get my keyboard right out of my way. This would be you. It would be your house. It'd be your car. I'll give you a body. Your family. It would be your checking account. It'd be the things that are in your personal name, that your 401k, your IRA, things that are individual to you, that are in your personal realm. Like, I can never really escape my personal liability for things that I do. Like, if I drive a car, I can't offset that even into another entity, things like that. What I can do, though, is separate out, like, my non-risk assets. This is your brokerage. This might be your metals. This might be your crypto. These are things that do not create liability. So me, my family, we can create liability. So we tend to look at that very critically when we're I'm going to give this a chimney so you can see the house. We look at those very critically when we are doing asset protection, because we want to make sure that we're isolating the stuff that doesn't create liabilities, and we isolate them in an entity, generally speaking, something like a limited liability company. You will learn this, by the way, if you join the Infinity program. You'll get an introduction into that. You will have access to this information. We can break these things down. You can even sit with our attorneys and accountants, and we will break it down for you. On the other side, on the bottom side of this personal realm, we have your business. And a lot of people are sole proprietors, or they're S Corp, or they have an active business partnership. And then you have risk assets. It's like the sole proprietor might be, I have a plumbing company, or I have a real estate agent. I have an S Corp, maybe I have an accounting firm, an engineering firm. I have a restaurant or something. Maybe you have a partnership with my cousin Ned, and we'd have a pizza shop. They have a business, and the business creates liability. And so you guessed it, we're always going to put a box around that activity, like at least all of our businesses, but we break them out. Like in asset protection, you're looking at making sure you're isolating out each liability, each activity from the others, so that you don't lose them all if something happens. Then you have risk assets, and risk assets, really real estate. This is rental real estate. And again, generally speaking, you're putting a box around it. So we're not going there today. I'm just showing you the assets, because what people don't realize is that in this little quadrant right up here, they have access to a ton of cash that you can put down into here. If you want to unlock in the power of real estate, you can absolutely do it through your IRA, your 401k, even your own home. People don't realize this. Like a HELOC, all that is using that's a home equity line of credit. It's simply using your property as collateral. There's not a restriction on the use of that money. You can literally take a mortgage off of a property and go buy other property with it. The beauty there is that it's an investment expense. You can actually write it off. You don't have to worry about your standard deduction and all that. A lot of people, their accountant tells them, oh, there's a limit on how much you can write off as a mortgage, or you're taking the standard deduction. You don't get to take a deduction for your state and local taxes or your mortgage or your medical expenses. There's all ways around that when you start going into the investment world. Or you have your IRA and you're with TD Ameritrade or something like that, and they're saying, hey, you can't buy real estate. So you're like, oh, I can't buy real estate in an IRA. Actually, you can. You just can't buy it in their IRA. And we'll show you how to get your own. When we're talking about the infinity process, and you're going to get very well acquainted with this afternoon because Nicole's going to go over how everything works. But from an asset standpoint, I'm looking at you. I'm looking at, hey, even here, by the way, a lot of you guys don't realize this. I can lever my brokerage account. I don't have to sell any stocks. I can lever them. I can lever crypto, and I could buy more assets. I could lever the assets in my business, easy, and continue to accumulate more real estate. We want to isolate it from a liability standpoint, but we can absolutely build it. How many of you guys knew that? So, by the way, Stephen, I said it was $2,500 per ADU, and it was 10 ADUs on a single property. They were generating $25,000 a month just in the ADUs. All right. Some of you guys knew that you could do this, but here's what's interesting, like a brokerage account. Let's say I have, a decent-sized brokerage account. Maybe I have $500,000. A lot of people don't realize that you could do something called a security-backed line of credit and use it as collateral. You don't even have to sell the brokerage account. I don't have to sell the stocks. And maybe I'll do 50%. I'm not going to do that. Like they'll give you up to 70%, but as we've learned, the market can fluctuate. You don't want a cash call. So you could absolutely use the security as a collateral on a loan so that you can access the capital and put it into additional assets. And that works absolutely perfect. Now, where this lies in, and I want to kind of get into this, the flow between what you make and the assets that you own